Hey guys, welcome back. Chris Gunnels with Real Financial Success. I wanted to go over a simple earnings trade for June 12th, 2018. And the stock that we're going to work with is H&R Block. Now, what I decided to do was actually just do a simple naked put. The reason why I decided to do a naked put is because there's a lot of premium in it that we can actually get a good credit, and the stock price is actually pretty low. So if it goes against us, it's not going to be that big of a deal. We can actually be assigned the stock if we don't mind, or we can roll out, and it makes it easy for us to roll out with the stock being such a low price. Okay, so here's the play. Basically, the last price before the bell closed, or I guess right at the time the bell closed today, the market, not the bell, it was $29.60. Now, the earnings for H&R Block, it came out already right after the bell as indicated by this icon. And what's cool, actually, that I noticed as I opened this up about 30 minutes ago was that the market had already decided what it felt the price was going to be, or what the stock is worth after the earnings. As you can tell, the market has decided that the earnings may have been bad, or their forecasting is going to be bad for the future earnings. Either way, that doesn't really concern me. What I decided to do was put in a working order for the 24 strike June 15th expiration. And it's not showing here, but this is basically what I have working, is a 24 strike with the June 15th expiration, and I'm actually I'm trying to sell it for $1.40. Now, why am I trying to sell this out of the money option for $1.40? Well, I believe the two reasons. The market is saying that they believe that that's what the stock is worth. So come opening market at the bell in the morning, if this stays the same or right around the same, the stock will gap down from $29.60 down to $24, somewhere around there. And what that will do is that will make my option that I'm trying to sell for $1.40, that will be right in the money or at the money, or right there close to the money, right? And with a high implied volatility, I believe that I can possibly get filled. The reason why I chose 24 also was because the plus minus, the market makers are assuming that, or they believe that the market for this specific stock is going to go up or down $5.40, or right around there. So from $29.60 down to 24, that's right in the sweet spot. Okay, you could also go the other way, and if you believe that the market's going to go up from 29 to 34 or $5 or whatever, you could try and sell that option as well. But my hunch is that you'd be super in the money if you did that, deep in the money, as they say. So again, to recap, the reason is because I believe I can sell this 24. I believe I'll be on the very low end of the market for this specific stock. I don't believe it will go too much lower. And if it does, that's fine. I can, to adjust that, I can actually roll this strike out to July for an additional credit, and that way it'll give me more extrinsic value where I won't be assigned the stock. And let me show you a visual of that. So here's the visual risk profile, if you will, of the current trade that I have working. Of course, it's not, I don't have the trade on yet. It's just a working order. It hasn't been filled. So again, here's the strike price, 24. Okay, this is my working order, and basically anything in the green right here is where I can profit. Anything in the red, obviously, is where I would lose money. Now, I have the 24 strike, and my break even is down here at, I think it's like 22.60, somewhere around there. And the reason why is because your break even is your strike price minus the credit you receive, and so in this case $1.40. Now, if in the morning when the stock market opens, currently right now the market closed way up here at 29.60 or whatever it was, and at the moment the market is saying we're going to pay around $24, or we're willing to buy and sell right around $24. And my belief, my assumption is that it has moved all the way down to as far as it'll go. And so in the morning, I believe that hopefully I can get filled. I might be able to get filled for a little bit less than this. But if I get filled, I believe also that the market might move back up throughout the day. And at that point, what I can do is close this trade for a profit. And if the market goes down, let's say it goes down to 22 right here, I could potentially be losing money, or rather I will lose money if I decided to close out that trade right away. But what I do instead is I decide to actually roll this current trade out to July. Again, this is an expiration of June 15th. I can roll it out to the next expiration cycle, which in this case I believe is July 20th. And by doing that, I can take in an additional credit, which would move my break even down, which will make it so that I'm not losing money anymore. And it gives me more time for the market, for H&R Block to actually come back in the money for me, or rather out of the money. So I hope that made sense for you guys. It was really quick. It wasn't scripted at all. I didn't have much time to put this together. And before I let you go, remember, come to Tasty Works and sign up. Again, the reason why I think you should sign up is because their commissions are a lot lower than other trading platforms or brokers out there. And for instance, they don't charge to close your positions. Okay, guys, thanks for watching. Have a good one. We'll see you next time.